So we already are getting calls on what happened to the market today. Why are we down so significantly today? So maybe we'll start with a little explanation on why we're down 95 basis points on mortgage bonds. And then Katie, maybe we'll take a look at some technical analysis on mortgage bonds and treasuries. Everybody's looking, but from a fundamental side, everyone, we talked about it a lot in today's update. So you have inflation, and we all should be on the same page by now that mortgage bonds hate inflation, right? That's the overall driver of rates. So we had all prices rise. You had the State of the Union address last night. There's two things that happened. State of the Union address, no talk about how we're going to alleviate the shortage in oil due to now Russia being cut off from both SWIFT for transactions. BP and Exxon don't know how they're going to get paid, so they're backing out, as well as you have those Russian exports that we would normally count on. So how does the world then figure out how to replace a 4 or 5 million barrel a day hole in oil production? Well, OPEC had a meeting today that lasted 10 minutes. And in that 10-minute meeting, what they said is, no, we're just going to do our regular 400,000 barrel increase until we get to pre-pandemic levels, and then no relief further than that. Disappointing. Now, some people might say, well, Biden last night said that we're going to open up 30 million barrels strategic reserve. That seems like a lot, right? But do you know we use 18 million barrels a day? So when you take a look at that, it's like not even a day and a half's worth, okay? So it gets a lot of applause, but it means absolutely nothing, okay? It's empty. What the markets were looking for was for the president to say, hey, we'll take our foot off the neck of the oil and gas producers and now start to increase production. In the absence of that, oil shot up about $10 between last night and this morning per barrel. Each barrel, about 42 gallons of gasoline. So it kind of gives you an idea on the percentage increase that you could see at the pump. That's inflationary. Mortgage bonds hate that. That's one thing that happened. The other thing that happened fundamentally is you had our chair, Jerome Powell. I hate to say this, but doesn't appear to have any backbone. He is certainly no Alan Greenspan and definitely no Paul Volcker, where the afraid of my own shadow once again comes to be, because the situation in Ukraine and Russia, while very important, he is now letting that dictate domestic policy against inflation. And here's what he said. Well, now we thought about 50 basis points, and now let's go 25. So the fearfulness of the Fed and the lack of leadership, mortgage bonds say, hey, the Fed's not serious about fighting inflation. And now you've got down 95 basis points today because of fears of the Fed's inability and ineptness to do anything meaningful to fight inflation. This is all, you can go to our forecast for the year. This all kind of was laid out and played out there so you could see now things unfolding and the explanations are all there. But it is a sad state of affairs when we don't have, look, if I were Fed chair, I would say, kind of like an Alan Greenspan, here's what we're doing. For the next year, there's 8 Fed meetings. You're going to expect, regardless of what happens in Russia, what happens in Ukraine, it doesn't matter. There's going to be a 25 basis point hike at each of the next Fed meetings. We're not going to stop till we get to a 2% Fed funds rate, period. And we're not going to be a mad scientist. We're going to start saying, oh, let's try and unload the balance sheet, or let's reduce the balance, one thing at a time. We're going to raise 200 basis points, and then we will take a look and see, do we need more hikes? Do we need to do something with the balance sheet? We're going to immediately stop buying new mortgage-backed securities. They'll still reinvest $70 billion a month, but none of the stupidity like, hey, you know what? I need to lose some weight, so I'll start my diet in May, and until then, I'll eat every piece of cake in sight and gain 20 pounds until I start my diet. That's what the Fed's doing right now. Only the stupidity of the Fed, only the logic that a 5-year-old would be able to comprehend better than the Fed. And this is why you get boom and bust cycles in the US. Katie, I'm going to get off my soapbox right now, but that's fundamentally the sad state of affairs of what's happening. Let's hopefully go to the logic of technical analysis and see if we can break this down any better.
Yeah, for sure, Barry. So forgive me, I didn't realize we were already live. Hi, everyone. So essentially the S&P 500 is rebounding. Everything's macro and geopolitical these days. There's really not much use in doing much bottom up work because everything's gotten so highly correlated and of course also highly volatile. And that's been our incredible challenge year to date. And the challenge is shared by your space as well, mortgage-backed securities. Treasury yields are sort of near and dear to what we're doing. So I think if we could start there, do you mind if I share my screen, Barry? Would that work?
Yeah, I believe that that Megan can procure that, so we can do a little
Yes.
screen here.
You should be
Okay.
able to.
Now, hopefully y'all can see this. Can you see the screen?
Yes, we can.
Okay, wonderful. So I want to first start with a very long-term view because I think that's really important. I'm going to bring up some slides over here. The reason being, we really need to contextualize the volatility in a long-term time frame because that's going to keep us sane for one. And here we go from current slide.
And by the way, Megan, I also want to that chart of WTI that we used this morning in the update. Can you both, number one, just give it to me so I have it handy in an email, and also be on standby to bring that slide up. Okay, Megan?
Great. So as it pertains to the long-term view, this is decades-long 10-year treasury yields. And you can see still a long-term downtrend channel. But of course, within that context, there has been sort of a shift in terms of momentum to the upside. You can see that here. This is called the MACD indicator for those of you who know it. It's a very common technical tool designed to gauge momentum and also the prevailing trends. So within the context of this wide long-term downtrend channel, we of course have upside momentum behind treasury yields. And you can see that in this uptrend drawn back to the 2020 low. That uptrend line puts support for treasury yields right around 1.5, although there is some interim support that I'll show you on the daily chart as well. But the context here shows resistance potentially based on a Fibonacci retracement level of roughly 2.13%. So that to us from a technical perspective, without knowing anything, Fed related or otherwise, that to us is a pretty big hurdle on the chart. If we were to see that hurdle cleared, then our attention would turn to the upper boundary of that downtrend channel, roughly between about 2.55 and 2.6 at this time. But as you know, it moves lower over time. And not until we see that level surmounted could we suggest that this is the start of something that's really decades in the making, as opposed to something that still needs to be viewed overall as a counter trend move. Because it is somewhat counter trend in nature, we need to really frame that when we analyze our short-term work. Let me get to the short-term view. On treasury yields, of course, we have with the weekly bar chart that you see here, forgive me, I have a lot of levels drawn on here, so it might look a little bit messy. But what you can see here is a breakout above this turquoise line, which was the 1.79% level based on a half retracement of the downtrend that preceded this uptrend. So that was a natural place for us to say, okay, well, this uptrend is extending itself. That became that 2.13% target. And now, of course, within this context, we're seeing a pullback following the breakout. This shows the DeMark indicators. The DeMark indicators are really very informational for us in terms of discerning when an uptrend may be short-term exhausting itself. So if you look at this up move in 10-year treasury yields, you can see that it flashed this red arrow, which is a down signal based on the DeMark indicators. It supports another 2 weeks of consolidation. Other times it has actually been a little bit more prolonged than the normal implications. We had one of those sell signals here that was at the peak in October last year and back in here ahead of the peak from sort of early part of 2021. So we are, what we think we are looking at is sort of the plateau within this longer term uptrend. So we're looking for more sideways to lower treasury yields here in the near term. And then to drill that in even further, if you look at the daily chart, this is kind of our fractal analysis here, just going into multiple time frames. Notice that this former resistance level that was about 1.7 is now a proposed support level. So there is short-term support very close by, perhaps, sort of contributing to what we're seeing today. And with that, we're getting to a short-term oversold reading. So it does support some stabilization here in the coming days. Whether that's going to be strong enough to prevent a little bit of a deeper pullback or consolidation within the uptrend, I don't feel great conviction in that. But if it does get taken out, then the next support is even more important. And that's roughly 1.5%. As mentioned, it's based on the uptrend line back to that 2020 low. And it's also based on the rising 200-day moving average. The 200-day, as many of you all probably know, is a very widely watched moving average. You can kind of see them both converging in here. And it's something that often becomes like sort of self-fulfilling support or resistance, depending on where the security stands relative to it. So we're looking for more sideways to lower here near term, but we are deferring to this uptrend drawn back to 2020, which we ultimately think will lead to a retest of this 213. And above that, it would target about 255 plus. Does that make sense to you, Barry?
It makes a lot of sense to us. And if we go to our chart that everybody has access to on the 10-year Treasury, we have a resistance level within fractional basis points that we're at 2.14 is where we are for our resistance based upon the Fibonacci retracement of 61.2%, 0.8%. So we're right in line with you. We're looking at it the same way, and I'm glad that we see it similarly.
Okay, very good. Now, should we chat about the equity market, or where do you want to take it from here, Barry?
I think that maybe to just keep it on yields, what I'd love to do is let's take a look at our mortgage-backed security chart together. So I can share my screen and I could pull that up in just a moment here with you. So let me grab it and pull it up here. And you should be able to see, although you might not want to see this, everyone, to see that we're down 102 basis points. And here's the chart that we're looking at here on mortgage-backed securities. And I'd love to get your take on this. So we have a Fibonacci retracement level here at 50%, which was really a very strong floor. We had since taken off from this level. And this was, again, driven by the Ukraine and Russian fears. And then where do I park my money? And then here we have this very large move lower today based upon the factors that we opened with, the lack of spine by the Fed, as well as the concerns of rising oil prices with no relief in sight of how we're going to make up the shortfall. So the assumption that oil prices might rise, I don't know, could we get back to that $147 a barrel level? I think it's quite possible that we saw in 2008, broke underneath the 25-day moving average. From a technical perspective, you can see here we're getting a little bit of a roll in the stochastic, but not from overbought levels. Where do you think the most natural move is here on mortgage-backed securities?
It kind of feels just like it's noise to me, to be honest. I know it's a big intraday move, and you can certainly see it there in the red bar. More often than not, those long red bodies have actually been lows, not highs.
Like here?
So, yeah. If you look at the red bodies more, they tend to be sort of not always, but sometimes reversal days. It wouldn't totally make sense this time around because it follows an up move. But what that up move did, and we have a Substack newsletter now that we put out an idea in TLT, which is of course positively correlated to this. So we're more constructive here, sort of to the inverse of what we were saying with treasury yields. The oversold bounce, if you want to call it that, does have enough of a momentum shift to suggest that it will be lasting. And I think using your tools that you have shown on your chart, one, the stochastics, even after today, are still pointing higher. They still have room to overbought territory being 80 or maybe that's 75%. And also notice the slope on your 25-day moving average. Notice how that has flattened, right? So that's a differentiating sort of point rather than previous sort of up moves that have been highlighted, right? So it really does feel like it's somewhat of a significant momentum shift. In terms of the I guess proposed duration of this kind of oversold bounce relief rally. So I actually think today's maybe just noise, certainly news related, and that we'll see more sort of grind sideways to higher here in the near term.
That's very, very helpful. And for those listening, very encouraging. And yeah, here's, you see that big candle after down move. This is, I guess, Katie, would call this kind of almost like a capitulation move, where you see the big down after a downtrend, the big capitulation where it's like a washout. And then it means a change of direction from down to either up or down to either sideways. And here's down to up, down to side. Didn't happen here because it was, yes, it happened, but it wasn't after the down move. But these things don't always fall exactly as the script goes, but you could see definitely some similarities, right?
Yeah.
And then the 10-year Treasury yield, which is rallying today, if you take this a little bit out, you could see that we have that same level of resistance here at 214. Well, I think we have it at 2.16 as the Fibonacci retracement here, but probably because we're looking at a slightly different time frame. But yeah, we tried to pierce the 50-day moving average here, and I'll just bring it closer so you could see it. We tried to pierce the 50-day, and that didn't go. So now it looks as if yields are kind of above this Fibonacci level, but as well as above the 50-day. But if we can suck back underneath this Fibonacci level, then yeah, I see what you're saying here, Katie, that the trend of late is definitely one where we're looking at a downward trend, which is counter to the longer term trend that we're in.
That's right. Sort of a corrective phase that still has a little bit of room here is the way I would put it. So we have a short-term oversold reading, and yet the momentum is somewhat to the downside there. So I think that we defer to these counter trend moves as likely to persist here. And I'd say the duration for that, at least in my work, is something to the effect of 2 to 4 weeks in terms of, the continuation of not what we're seeing today, but what we saw before today.
So Katie, I guess a lot of people are going to be interested, and it's always a hot button with the S&P to give us a direction of the stock market as well as cryptocurrencies. So we could take a proxy and maybe Bitcoin and Ethereum, maybe the S&P and NASDAQ, if we could take a look at those for good proxies for stock market. And then of course, if our viewers are interested in something specific, time permitting, let's take a look at those. So pop those into the chat, right, Megan?
Okay. Yes. So essentially Bitcoin, I know that we have a question in the chat room about it for sure as a place to start. And listen, like I said, it's all about top down sort of macro geopolitical trends and risk right now. And correlations with that have gone pretty high across the board for risk assets and otherwise year to date. That includes Bitcoin, it includes Ether, and that's something you can quantify. I mean, if you look at the correlations across the equity market, commodities, et cetera, they've really kind of, I guess, contracted in a way, or not contracted, but increased this year to date. So we have seen Bitcoin, after a pretty sizable correction, if you still want to call it that, come into some important support defined by the cloud. So if you see it on the shaded area of the chart here, this is a metric. It's called Ichimoku. It's a model that's very common, more so in Europe and Asia than here in the US, but it's a great visual gauge of the prevailing trend and some support, especially for FX. And you can see it kind of came and bounced around here along that support level. We have seen a distinct loss of downside momentum to that corrective phase. You can see where this histogram here on the MACD becomes lighter. That's where the loss of downside momentum is evident. And that's helped preserve that support level, which is important because if it is broken decisively, which for us means 2 weekly closes below, the targeted level becomes 27.2 thousand thereabouts. But also it just reverses this uptrend defined by the cloud. So that would be a pretty notable long-term development. We certainly wouldn't rule that out, unfortunately, this year for Bitcoin. And we say that because if you were to look at the monthly chart, just like the equity market, there's been a very distinct loss of long-term upside momentum evident on the monthly MACDs. But for now, we're focusing on the relief rally that's underway. We have a stochastic upturn. So that would be essentially like an intermediate term oversold buy signal, that type of thing. And a breakout right now over the daily cloud, which targets about 50 to 51,000 in terms of the next hurdle on the chart, based in part on what you see here, which is a 50% retracement level of this downdraft. So we are looking for a greater relief rally from Bitcoin and also from the equity market. We have today, let me exit
well, Katie, before you go, let's just stick with this chart for a second. So we try and look and see if history can repeat itself. A similar scenario in the summer months, if you take a look at the loss of downside momentum, right? So you had that big drop that you see there. You see that peak to the drop that occurred over the summer. So if you want to highlight that above that, you see the drop in the price above that, right?
Yep.
So you see that price big drop, but then there was a loss in downside momentum that occurred. And then the rally that ensued was, a little, let's call it 30,000 to 68,000 or 69,000. It was a very, very powerful rally, which took a little bit of a breather in between, but it was a very, very powerful rally. So now we see something that kind of sets up similarly, where you see that big drop, big downside momentum, but then a sideways move, loss of downside momentum. Could we potentially see a higher high because we saw a lower low? And could you potentially see a 70 or 70+ thousand move in Bitcoin that kind of would suggest that this might be a good entry point here?
I think what we have is sort of a convincing, maybe short to intermediate term entry point based on the very new breakout that we have. In fact, it's really being confirmed as of today. And yet here's the difference, right? The difference isn't actually really visible on that weekly candlestick chart, but rather, let me pull up the monthly. And this is where it's kind of worse this time, unfortunately. I don't want to be the bearer of bad news, but it is what it is. We have on this monthly MACD of Bitcoin, notice that it is now pointing lower. That's effectively a momentum sell signal on a long-term basis. And with that, you can also see a negative divergence. So when Bitcoin made a higher high, notice the stochastic oscillator here made a lower high. And that means that we aren't really in a comparable environment to here, just in terms of the loss of momentum on a long-term basis. So I do think there's a lower chance because of what you see here that we will see Bitcoin get up to new highs in the months ahead. Obviously, you can't rule anything out. There's going to be plenty of volatility in store in both directions here, but I think this year is going to be not just for Bitcoin, but for equities, sort of a digestion year. A lot of backing and filling, probably overall more neutral than actually lower, but that new highs will be difficult kind of across the board because of these same issues on the monthly chart. So we have, the S&P 500 as of this month, flipping to a MACD sell signal on the monthly chart too. And usually that, it's a late indication of what we know has already happened, which is a pretty sizable corrective phase. But usually we don't really come out of that very quickly in a very strong fashion. I keep going back to the 2018 comparison, where we had coming into a very strong rally and then a corrective phase at the start of the year, followed by a pretty substantial mid-year relief rally. Even took the S&P 500 up to a new high incrementally before that nasty Q4 2018 corrective phase. Overall, that 2018 period was pretty much a neutral year and then served as the staging ground for obviously strength all the way through the COVID corrective phase. So I have sort of the same playbook in mind for the S&P 500. And I do think that the correlations with other risk assets will remain pretty high.
Megan, are you seeing anything that people are wanting to look at? I think one of the things we wanted to focus on was the NASDAQ, right? Maybe you'll take a look at the NASDAQ 100.
Yes, many people wanted to see that.
So we showed actually in our research report today, if I can open that, on triple Q, which is a proxy obviously for the NASDAQ 100 index. There are some signs of not just short-term downside exhaustion, but also intermediate-term downside exhaustion. And they're not wholly decisive yet. I couldn't label it that way. But it's enough to suggest that we probably have an intermediate term low being established here. So let me show this on the page 3 here. Here we are. So hopefully you can see this okay. It's effectively a corrective phase that's given way to what we call a 9-buy signal in the DeMark work. So that DeMark signal that we have, it's a counter trend indication that affirms the oversold upturn that we have in the weekly stochastics. And notice that triple Q and also the NASDAQ 100 have come into support based on that same cloud model. Similar to what happened back in early 2020, it also held around the bottom boundary of that cloud. So while the momentum's still very clearly to the downside, you can make the case for at least a 4-week relief rally and potentially something that ends up being a bit more pronounced than that, as we see the intermediate term momentum perhaps continue to improve or sort of wane to the downside at a minimum. So no decisive buy signals yet, but kind of indications that an intermediate term low is being established with the potential for a greater relief rally. We are advocating that folks sort of take down their top-down market hedges and looking for opportunities on the long side with more of a short to intermediate term time frame. We're pretty comfortable buying stocks here that are kind of like triple Q, right? Where they've got that sign of downside exhaustion and leaning a bit kind of safer, I think, in the exposure that we're recommending, comfortable with the FANG stocks for one. So the mega caps, Apple, Nvidia, Google, Microsoft, these all, you can make a compelling case to resume higher, probably not getting to new highs based on the way the long-term gauge is set up, but certainly for a relief rally that's somewhat tradable. We think those are fair game. Even Tesla would fall into that category. It's a little bit riskier to put on counter trend positions, as you can imagine, in the likes of like a Facebook or an Amazon, which are now both technically in downtrends, and Netflix included. But you can definitely, if you have attention to risk management, keeping a very tight stop loss, you can certainly get some outperformance there at times with these counter trend positions, because they tend to be sort of higher beta. There's a lot of stocks out there that have just been incredibly beaten up, especially on the high growth front, that are prone to these sort of bigger snapbacks just solely based on how, I guess, stretched down below the initial resistance level they've gotten. So look at, any name, like, I don't know, I always, my head goes to Zoom as an example, although it's probably not the best example. Any stock that's really stretched to the downside, if you just look at the spread between the current price and the 50-day moving average, it's really astounding. I mean, you're talking about 15, 20% in some cases. So that's where your risk is higher, but also your potential reward is higher when you get these short-term counter trend moves.
So we're looking at some of the, if we're to take a look at some of the stocks that have been beaten up, or just if you wanted to say like a triple Q, it appears that the downside is either close to nearing a potential of being exhausted to the downside. And the snapback, would you say a 50% recovery or 50% retracement without too much overhead resistance to get there? So that would give you, if you took the delta, and 50% could be a reasonable target in a counter trend trade to say, look, I want to, it's down whatever on the triple Q. So you've gone from, 400 to, 340, 350 now. So if I take half that move or something like that and say, well, there's maybe a 10% upside gain that I can make, or 8% upside gain in a short period of time.
Yeah, I mean, listen, I think that's pretty well aligned with what we're saying is initial resistance. And initial resistance for us is often defined by that 50-day moving average. And then there's often other levels that are coming into play too. So if we take the triple Qs as our example, here's your corrective phase from the November high, of course, to that to the low from last week. And if you take the 50% retracement, that's around 363.5. It doesn't look like much, but that right there is nearly 5% upside from here. The 50-day is maybe closer to 6%, and the cloud is right at 7% in terms of the upside. Those are all, except for the 50%, those are kind of moving targets, but let's put it this way: 5 to 7% upside to initial resistance levels is pretty compelling. So I think that even that right there is enough to incent people to put on short-term positions. And then then where we would, take those off or get less constructive again is when you start to see reactions to overbought readings, when the stochastics broadly start to roll over, or when we start to get those DeMark sell signals again. Those are the types of things that would tell us to close out these counter trend positions. We just want to make sure that we're very nimble with a lot of attention to risk management. And that's really largely because of what we saw on these monthly charts, which is the very distinct loss of long-term momentum. And when you look at the DeMark indicators on these monthlies, this is triple Q still, in January, it flashed a sell signal, the likes of which we hadn't seen since 2017-18. And that signal has implications for another 7 months. So that tells us that, we could be in the start of sort of a range bound corrective phase that lasts into, almost into the fourth quarter of this year. So I think it's going to continue to be difficult, and taking advantage of these short-term moves it requires a little bit more work on our part, but I think it's important to try to capture them, because that's where you'll get your returns for the year.
So in other words, most of the gain potentially, if we're in a sideways to lower trending market for the first, better than half of the year, the counter trend moves is what where you would probably make your profitability. However, like any counter trend move, as you said, you have to be very nimble, because you're going against the trend for a short period of time. So it's not like a set it and forget it. You have to be very, very nimble as to when to, you have to probably have a pretty disciplined drawdown level and maybe hit a target. When you hit it, let's not be greedy and take that target and go. Am I right?
Yeah, I think that's completely accurate. It's just not a year where the buy and hold is going to be our friend, that strategy. And the other thing that I would just bring up to that point.
By the way, Katie, before we just continue, and it's underscored by one of our very astute listeners here, is that we've noticed that a very accurate turning point, one of the ones, we like to look at confluences, something we like to kind of call it the leash effect. We've noticed that mortgage-backed securities, when they get too far off their 25-day moving average, it's very reliable, especially if there's a confluence, if it's off of support or resistance or whatever it is, that they do tend to have that snapback. And it looks as if for the QQQ, as you've illustrated here, the 50-day moving average may act as that kind of leash effect, where if it gets too far past its 50-day, either up or down, that it's definitely going to flash a warning sign to you. A warning sign or an opportunity.
That's right. So when you see that how stretched they get from the moving average, and then also you have an impetus to the upside or downside from maybe an overbought, oversold perspective, that's where you have sort of a great indication from the charts. This is MBB, which is a mortgage-backed securities ETF. So see how the 50-day, that's in green here, right? I mean, it got stretched very well below. Not until recently, though, was there an oversold buy signal. So not until, this is the DeMark indicators on this day. So that was February 23rd, there was a DeMark signal that suggests, well, not only is it stretched down below this initial resistance, which you can see was pretty reliable here as a resistance level, we couldn't really turn our attention back to it until we had some kind of turnaround indicated. And indeed, we still have this. And even with today's action, that signal is still very much intact and valid.
Katie, I think we've got some questions. I don't know what you have and that you'd like to review, but gold has been on the move of late, obviously, as a safe haven. So should we take a quick peek at gold as well?
Yeah, for sure. So just to show you on sort of a big picture, long-term basis, you can see on this cloud chart here that effectively gold has completed a long-term triangle formation to the upside. And this breakout is confirmed, it's decisive. Triangles I have found to be the highest probability pattern over the course of my career. And so we tend to really see good follow through. This is a monthly breakout, so that it doesn't mean it has to go higher in the next 2 weeks, but it does suggest that over the next several months and potentially longer than that, that will see gold prices work their way higher. Effectively, they've resumed the long-term uptrend that preceded this sort of triangle formation. And notice
what's
with
the
that
target on that, Katie? What would that target be?
that's 2063 per ounce. And it's just simply based on the tail sort of resistance level here. It's an all-time high. Arguably, it's not the most important level because it really didn't spend much time up there, right? So it's not a real insurmountable looking level. Other people like to look at not just resistance, but the width of the triangle to kind of project upside. And you can see it's a pretty wide triangle, so that would be a pretty impressive up move too. So most of the indicators are turning up, if not already having turned up. You have the weekly or the monthly stochastics pointing higher, and the monthly MACD is on the verge of a buy signal. So I think that's the most important thing to note on the price of gold. And then near term, I think it's probably a little bit stretched, but that's not necessarily an indication of a sharp pullback, but rather consolidation perhaps is normal once you get the overbought reading like it has. But I think that I'd feel pretty comfortable having positions in gold, even knowing that they might be somewhat neutral here in the near term. Crude oil, on the other hand, I assume that's going to be a question.
Yes.
Yeah, it's really, I mean, it's been wild. So we took down, or we were overweight energy as a sector on the equity front for several weeks to ride this uptrend. And we closed that out. I don't know if it was last week or the week before, but certainly too early based on the trajectory of crude oil. However, the energy stocks haven't maintained the same level of upside momentum as the commodity itself has. So if you look at it's just really wild to see just with today's action, this acceleration higher. With that, it stopped out some short-term sell signals. You can see this blue 20-day moving average is still pointing higher. But importantly, this steep rally, of course, steep rallies tend to be less easy or harder to sustain. With this steep up move, it has finally come into this long-term resistance. And this has been on our radar for, I don't know, more than a year probably. And it's this pretty strong resistance back here starting around 110. It is coming up there, of course, with an overbought reading across time frames. So we do think that this is a natural place to see crude oil prices start to stall out. And yet it's really the only sector, if you're looking at energy stocks, they're the only ones that have really worked year to date. So I don't want to, minimize their leadership. The catch is that now those energy stocks, unfortunately for some people, are now like a much too big part of their portfolio as a percentage, right? So I think that now is probably a good time to start to reduce. This is I just think fascinating. Look at the energy sector year-to-date return, 31%, and then look at everything else, right? So that's what's happened, and it's just something that gives you a little bit of pause. It's certainly an adding exposure here, but also gives you a sense that maybe some profits should be taken.
Such a difficult one, because then that all makes sense fundamentally as far as what you should do with your accounts. But boy, it's so volatile because news can just change that right away with the energy markets.
Oh yeah, and that's this kind of environment, right? So we have to acknowledge that the risks are far greater than average in this kind of environment. It's not a normal environment. And when you have events, potentially nuclear or what have terrorism, anything like of that nature, you have to trust that the levels are going to be less reliable. And it's unfortunate, but it does happen at times. So the best we can do is kind of work with the information that we have right now. And the information that we have right now is that crude oil prices don't have any support until the low 80s. So that to me right there is a pretty uncomfortable amount of risk to take if it does pivot lower, which you assume at some point it will, whether it's news related or just simply because it just the buyers step away, right? Just kind of a lack of demand. So I do think that there's certainly risk associated with how stretched they are from support.
So couple of things here. I know I'm looking, Megan, if first of all, if there's any questions to answer, because I want to be cognizant of time for everybody that's on this call. And we are so grateful to Katie. But Katie, I know that you've been so kind as to do something special for MBS Highway subscribers that would like to get more of what you're doing and maybe have some of your guidance on trades. It's always amazing, and I'm so blessed to have you as a good friend, Katie, where we can communicate with each other, and you add so much, and I hope that I've been able to add things back for you as well. And it's great, hearing your side of the technicals, and again, I hope that I've been able to provide some good information back. But how can our subscribers get more in touch with you, more in tune with you, and get your guidance for their own personal benefit?
Thanks, Barry. And yes, I really also appreciate our friendship and, our sort of information exchange too. It's always good to hear a different perspective, and our focuses tend to be in different areas of the market. And yet we have sort of remarkably similar disciplines. And I think that makes it all that much more interesting, and we can kind of come at it from an unbiased perspective and often arrive at the same conclusions. And thanks, of course, for this. In terms of the subscriptions, we also offer subscriptions. All the information is on the website. It's fairleadstrategies.com. You can sign up for a free trial for a month. And it's almost getting a little bit unwieldy, all that we're publishing right now. We just added a Substack newsletter, which is very low priced, and it has just trade ideas. So we put on there Microsoft this week, but we often go a bit farther down the market cap spectrum in that newsletter format. And that's offered alongside our equity research. We also have cryptocurrency research that's weekly in nature. And we offer consulting services as well. So please, by all means, check it out. And we always are glad to have the personal referral and reference from you guys. So thank you.
Yeah, I can tell you, it's well worth it. And at minimum, take Katie up on the generous free trial that she's offering. But more importantly, it's incredibly affordable and inexpensive to get this type of insights, advice, and guidance from a source that's just about as good as it gets. Katie, is there anything else that's on your radar that you're looking at that you say is maybe a favorite trade that you're looking at right now? And maybe there's something that you say, hey, take a good look at this. Here's something I think say that's a great setup. Nothing's a guarantee, but it looks like a great setup right now that's got your eye.
Yeah, I think that's actually great. Let me just close this out because I'll show you on the Microsoft chart, because I think it's sort of exemplary of what we're looking for from the market right now. I'll show you just the combination of the time frames here too. So on Microsoft on a daily chart, what we see here is a positive MACD divergence, so lower low, higher low, and a buy signal. And then here's the 20-day moving average. You see it's starting to try to flatten out a little bit here, with Microsoft inching above that purple line, which is the 200-day moving average. So some incremental improvement in short-term momentum there, certainly. And then with that, we have those same indications that we had on the triple Q chart, which is an oversold upturn from, I guess, below 20% on the weekly bar chart using that stochastic oscillator. If you see the green arrow there, it's quite small, but it shows the DeMark counter trend signal that's new as of this week. These are infrequent signals, by the way. I mean, you had to go way back. I don't even know. Here's the last one, 2016. I guess that's why we're somewhat excited about this. And it's happening above the support, which you can see is defined in part by a previous low and also the weekly cloud. So our sense is if something like this doesn't work, well, then we've got a bigger problem in terms of the broader equity market, because it's a pretty high probability setup. It doesn't minimize the fact that Microsoft and many others have this notable loss of long-term momentum. So we still had to be ultra, sort of nimble and with a lot of attention to risk management with that kind of loss of momentum. But from sort of, if your outlook can be, say, maybe 2 months or so, I think we do have an opportunity here.
What type of gain would you think is possible on that?
Yeah, so it seems if I mean, if the weekly stochastic upturn really is what I think it is, which is a proper intermediate term oversold buy signal, I think we should be able to get up to the 61.8%. So we talked recently just about the 50%. So the initial hurdle here is between about 310 and about 313. But if you could see a more aggressive upside target from that weekly improvement, and that would get Microsoft closer to sort of 319, 320 as a targeted objective. It's up a bit today, but that's another 6% or so of upside. And you can imagine that with that, you'd see the major indices forging higher as well. And I think just in this tape, you're going to be as well served by taking positions that are somewhat top down in orientation and not highly rewarded by a lot of bottom up work. So I wouldn't be afraid of picking up ETFs as an alternative to stocks to take advantage of these moves.
Well, Katie, as always, absolutely amazing. And Megan, I wonder if you could do us a favor and just in the chat window, in case anybody wants to just make it nice and easy, could you please put the website to get that trial or maybe to get more from Katie so that if people just wanted to easily click the link in the chat window, they could do so. And Megan's already done it. So there you have it. So don't hesitate. Go ahead and click on that. Katie, we appreciate you and we love you. You know, Katie's a contributor within CMA too. So many of you are, you know that Katie really teaches a lot of technical analysis within CMA. So if you want to learn from the best, that's part of CMA. And Katie, I really appreciate you. Thank you so much for doing this for us and giving a wealth of knowledge here. This has been great.
Of course. Same here, Barry. Take care. Bye, Megan.
Bye. Thank you, everyone.
Yeah, thank you everyone for tuning in. We appreciate all you guys. Hope you guys have a great one.